Jason Liu, Head of Investment Specialist here at Regional Wealth Management in Hong Leong Bank. And with me today is our Head of Research and Advisory, Mr. Ramon Miguel Koh. How are you feeling today, Ramon?
Well, I'm feeling great, Jason. Definitely a lot better than how the markets reacted to the FOMC outcome.
Oh, okay. That's fantastic. So hopefully that all of our clients, our valued clients' portfolios will feel a lot better heading into 2026 as well. Yeah. So, ladies and gentlemen, today what we will be covering is obviously the Fed's decision, which to no one's surprise came out to be one cut, which is amount to 25 basis points. We will be talking a little bit about what the two meetings are going to look like, and we are also going to talk. We are also going to cover what 2026 outlook looks like. And very importantly, of course, we will be covering what the equity markets will likely happen, what will likely happen in the equity markets, which I'm sure a lot of our valued clients are very keen to know on this, myself included. And we will touch a little bit about fixed income as well, and we will finish up with the house view. And before we kickstart to get started, all the views here are especially our house views and not intended for investment advice, but yeah, you should always check with your relationship manager. Make sure you have your risk profile first, and assess your portfolio needs before you choose any investments with us. So without further ado, I would like to hand over to the man of the hour, Mr. Ramon, who will take us through the next 20 to 25 minutes. Ramon, the floor is yours.
Thank you so much, Jason, and a very good evening to everyone. Thank you for spending the time in being with us here today. So let me just set the context, of what happened during the Fed meeting before we get into the slides. So the big news, as what Jason has mentioned, is that the Federal Reserve has cut its key interest rate by 25 basis points. Now, you might have heard some talk about a bigger cut, but the vote was very clear. The entire FOMC, with one exception, voted for this 25 basis point reduction, and the only person who disagreed was Stephen Myrick. He is a new appointee who wanted a more aggressive 50 basis point cut. But he was in the minority basically. So interestingly, even some of the more hawkish members, especially for those who were not very supportive of rate cuts before this, they voted with the majority this time, and it basically signaled a broad consensus for this move. And the reason for this is because of the US labor market. So for a very long time, the Fed described the US labor market as being very solid. But that's no longer the case. We are seeing some cracks, and in fact, I think the data has also spoken, right? We have seen 2-week employment reports in July and August, and a significant negative revision to previous data. And on top of that, even the unemployment rate has been ticking up for 2 months in a row. And now, I think the more important thing right now is what is the Fed's forward guidance. So the Fed, they have confirmed that there's going to be 2 more cuts for this year. So that's basically in the bag, but just 1 for next year. And this basically contrasts with market expectations of at least two more cuts for next year. And our house view here, we do think that the Fed should take it a step further and cut another 1 more time, which means that there should be 3 rate cuts for next year. And I think one note of caution is that the Fed's projection for 2026, which show US growth accelerating at only 1 rate cut, might be a little bit too optimistic. So now, if we were to go to the next slide, as shown by the slide here, is that the market basically disagrees with the Fed, and the market thinks that there's going to be more rate cuts for next year, at least from now until the end of 2026. And I think how the markets reacted to this was that US equities closed lower, and I would say that it's more towards likely digesting the rather measured easing approach for next year. US bond yields barely budged. If we were to look at the long tenor treasury yields, it's still higher as compared to a week back. So essentially what the bond markets are saying is that there's no surprises for now. Right. So for the more interesting part, I think let's take a look in terms of what are the forward implications on asset classes. So if we could now move to the next slide, And before we talk about this, let's just set a very simple context in terms of what lower interest rates actually mean. So in layman, lower rates mean lower borrowing costs. Okay, so essentially what it does is that it stimulates consumer spending, business investments, and it would then lead to a boost in company profits. So essentially it's basically good for US stocks. But, okay, there's a but here. Context matters, okay? So if the Fed cuts because the economy is already in a recession and the markets are already falling, then stocks would continue to drop, okay? But if they cut in anticipation of a recession, then the cuts could stall that recession, and more often than not, the markets would then rally. So on average, okay, what you are seeing here as shown on the left chart is that US equities, as proxied by the S&P 500, tend to rally following a cut, okay, and it delivers on average about 5% gains within 100 days, okay. But if you look at the range of returns, it's rather wide, right? It could range from positive 10% to negative 10%, depending on what the economic conditions are. So looking at the table on the right, I think you would see that depending on what the economy is doing, the context, it really depends on what the context is. So as such, from an investment strategy standpoint, we currently opt, okay, for a more balanced approach to US equity investing, meaning to also have bonds, okay, to complement this exposure with emerging market equities, which is something that we are overweight on.
Okay, so Ramon, just to maybe cap on the first slide again. So market is pricing in 4 more cuts from now until the end of 2026, correct?
Yeah.
But what we feel is there's
going to be about 5 cuts.
5 cuts.
Yes.
Okay. All right. And I guess the big question, when you show all this, is that is the US going through a recession?
Well, the answer to that is definitely no, okay, because currently if you look at, I think, GDP numbers, the US economy is still growing, and we are of the opinion and we have the view that it is a precautionary cut, or what we call as an insurance cut. And but the thing is that, okay, even though the US is not in a recession, our tactical view here is that we are short-term underweight on US equities because of a few reasons, such as firstly, extended valuations, secondly, extended price actions, and third, high earnings expectations, okay? So in essence, we are seeing a risk of a correction, okay? But over the longer term, we still do think that the tailwinds of artificial intelligence and soaring corporate profits, okay, in the US is still going to turn things around for at least US equities. And over here in the current environment, we are seeing some resemblance to the mid-90s, okay, when if you were to recall back then, the US Federal Reserve cut rates without the economy going into a recession, and it was helped by the tech boom back then. I think it's pretty much similar to what we are seeing with the artificial intelligence boom currently. Okay, yeah.
So basically, for our audience here, on the right hand side, you see a lot of dates there. So Ramon, which previous instance are we most similar looking like where we are right now?
I think it would be the mid-90s.
1995, that one?
Yeah.
Okay,
yeah,
all right.
Yeah.
So it looks like there will be positive equity markets, basically.
Yeah.
Is it? Yeah.
Right. Yeah. So now if we could go to the next slide. So I think over here, I just wanted to stress on one point, right? I mean, I did mention on the fact that we are tactically underweight on US, but I would say that being underweight, it does not mean that we are avoiding US equities altogether, right? It is about having some exposure, but not as much. Right, so for those of you who are listening to this and wondering, how should I structure this as a form of exposure, please do speak to your RMs if you would like to have more details on how to size this, okay? So coming back to this slide here, I think one concern as well that we hear is that markets are near all-time highs, okay? And the Fed is cutting, so won't this make the markets more expensive and more highly susceptible to a crash? Well, so firstly, I must say that this is not the first time that the Fed is cutting when markets are near all-time highs. And what we have here, we have 2 studies to show that there could be some upside momentum. So firstly, the Fed, cutting when US equities were near all-time highs, it has happened about 22 times since the 1980s. And within the next month, there was no clear pattern at all. It was roughly at about a 50% probability that the S&P 500 was higher. But if we were then to extend our time horizon, let's say within the next 3 months or 6 months, that probability it increases to about a range of 72 to 77% chance that the markets would move higher at an average gain of roughly about 2 to 3%. But what is remarkable is that based on this data that we have seen, over the next 1 year, US equities were up about 100% of the time with an average gain of about 14%. Now, the table on the right, it tells us, if I could summarize it, if we were to have 4 straight up months in the S&P 500, let's say from May to August, which has happened about 10 times since the 1950s, we can see that September tends to be quite a good month, even though it is seasonally bearish. And then if we were to look in terms of how might this impact the performance of the US stock markets as we head into the year end, the historical probability points to about 70%, right? And there is an 80% chance that the S&P 500 could be up within the next 12 months.
So what you're saying is that when I look at this, when I look at the two tables here, I see a lot of greens, all right? So there's every chance, well, history has shown us that there's more than a likelihood that equity markets will perform, but we at the same time are underweight developed markets. So whilst we are not saying get out, we are just saying that please hedge your bets or diversify. Is that correct? Is that what we're saying?
Yes, correct. So yeah, I do understand that looking at this data, it sounds very bullish for the US stock markets. Yeah. But I think it's, like I said, context is going to be extremely crucial. So today's starting point is different. And what I mean, I think I've mentioned about this very briefly earlier, that valuations in the US and the broader developed markets are already stretched. Earnings expectations have little margin for error. So in other words, what we are saying is that even though history suggests that gains are possible, if we talk about the risk-reward trade-off, it isn't as attractive as in the past cycles. So if we could move to the next slide. So in terms of investment styles and sectors that tend to flourish during the past easing cycles, being selective matters. So in short, what we have seen in the past is that your growth stocks like your technology, your communications services, and your consumer discretionary tend to be key beneficiaries. But on the other hand, if we look at value sectors like industrials, financials, and materials, it tend to lag as a whole. And investors know they've been saying that, usually in an easing cycle, you will see your small cap stocks tend to do very well. Well, that is true, but usually historically, if you were to look at the performance of small caps, it takes some time to actually feel good. So what do I mean here is that small cap stocks tend to pick up later in the easing cycle once investors have the confirmation that lower rates have indeed improved the economy.
So Ramon, when I look at this table on the right, one thing really sticks out to me, obviously, is the thing on the far right, which is technology. Everyone is asking, is technology and is AI overpriced?
Well, the answer to that, if we talk about very traditional valuation measures like price to earnings multiple, is definitely on the high side. I think it's trading at about forward PE about 28 times. It's definitely above 5-year averages, 10-year averages. But the thing about growth sectors like technology is that it's very important that we also consider what is the potential earnings growth. So now if you look at the tech sector specifically, for quarter 3, the expectations is that tech would still be the strongest performing in terms of earnings. I think it's expected to grow by about 20%. For this year, there are expectations that the tech sector could grow their earnings by about 27%. And heading into next year, there are also expectations that tech is still going to be one of the better performing ones, still growing at about roughly 20% for next year. So I think if we were to weigh the pros and cons, I think that tech as a whole still has some opportunities. but it's important that we have a very diversified portfolio, and this is one of the reasons why we have a neutral view on technology sector at the moment, even though historically we see that this sector has done pretty well.
Okay, so what you're saying is that have it in your portfolio, but have it in moderation, basically.
Correct, exactly.
Yeah, right? Have it be more diverse in your sectors,
yeah.
right? Yeah. Okay. I think we covered a bit on equities, but what is the likelihood impact to fixed income? Because just now we just mentioned that the interest rates is going to come down, and it's a known fact that when interest rates come down, bond prices go up. So is this what we can expect heading into 2026?
Yeah, it's good that you mentioned this, because if we now go to the next slide, all right, and whenever we talk about bonds, I think the starting point is always on treasury, so that's where we will start. And I think that we all here have heard about this rule that, when Fed cuts rates, bond yields fall and their prices go up. But I think it's a very important point that we clear certain misconceptions that not all bonds behave the same way, not all bonds are equal. Okay, so why? Again, context matters, okay? So in an environment where rate cuts, okay, are not associated with any recessions, you will see what you are seeing now, which is the chart on the left-hand side, that is your shorter duration treasury bonds outperforming your longer duration bonds, okay? So what you are seeing here is that the 3 to 5 years treasuries, as shown by the blue line, are doing better than the 5 to 7 years, who are then doing better than the 7 to 10 years. So in fact, the 10 to 20 year treasuries have been underwater in the last 1 year because of several reasons like growing debt concerns, Trump's volatile policies, and expectations of stronger future economic growth, which then causes bond yields to go up. So if I may just dive a little bit into what we are seeing here. Okay, so now if we talk about the shorter duration bonds like the 2 to 5 year bonds, these bonds are most sensitive to the Fed's moves. Okay, so they are like what I call a quick moving stream in terms that they react the fastest to a change in direction. So we have already seen yields fall significantly here. So much of the initial gain could be already behind us, but they still offer some form of reliable returns. And then on the other hand, on the other spectrum of the duration curve, you have the long-term bonds, right? And these long-term bonds, I would say that they pack a big punch in a recession. They tend to deliver very pretty returns when rates collapse, like for instance during the 2001 recession when the tech bubble burst, or during the global financial crisis in the year 2008, where, if I'm not mistaken, they delivered about 20 to 30% returns, which is pretty good. But the thing is that now, this time is different, okay, as we don't expect a deep recession to hit, which now basically leaves us with intermediate treasuries. There's about the 5 to 10 year, which we think that it is the sweet spot, okay, and they give you a meaningful yield without taking on that same level of risk as the longest dated bonds. And in fact, I think if we look back at historical precedents as well, that whenever we have this kind of environment and the Fed cuts, usually the intermediate treasuries would have one of the best risk-adjusted returns. So I think if we were to compare US government bonds versus corporate bonds, I would say that we still prefer corporates and investment grade to be very specific, and while on high yield we are more neutral. Yeah. Okay. So if we were to go on to the next slide, I think we could also talk about the other sectors of the US bond markets. So what we are seeing here, okay, is that we are comparing corporate bonds against the non-traditional bond sectors, which is also known as your securitized assets, like your asset-backed securities, your mortgage-backed securities, and whatnot. Because the key point on what we want to say here, what I want to say here, is that diversification within the bond markets will be absolutely crucial. Okay, so what you are seeing on the table on the left is that we look back at mild recession periods. You say we have to look at 1990, 1991, or the year 2001, which I would say that if we are wrong in our views of a soft landing, there could be a mild recession. Okay, but and we here think that, right, being positioned in securitized assets is one of those ways where it could still deliver quite good returns to your portfolio here. Okay, and it's pretty evident that high yield bonds, they do not do as well as shown by the negative returns here, right? So I think all in all, I think one of the best strategies, okay, to have this sort of exposure would be via the AHAM Global Income Fund, and this fund actually fits into the target of the PIMCO Income Fund, okay. And I think one thing that I'd like to touch on is that in the current environment, I think also which is quite similar to what we've seen in 2020 and 2021, where back then you would see your longer tenured treasury bond yields were higher and they were moving up, while your shorter tenured treasury bond yields were going lower. So in technical jargon, it's called a steepening of the US yield curve. We've seen that emerging market bonds have outperformed treasuries. Okay, so I guess it's pretty important that we look across to Asia, okay, in both the equities, in the bond markets. That would be a very prudent option. And I think for those of you who are keen in terms of how you could really structure your portfolio this way, please do reach out to your RMs to basically have more information.
Okay, so in summary, we like shorter term corporates, investment grade preferably, and should we be, well, our view is that there will be a soft landing. But should there be a mild recession, if the view is wrong, if the data comes in much softer and there is a mild recession, your so-called non-traditional security-backed assets will be more, fixed income will be more in favor. And like you mentioned, we do have funds that actually cover this type of asset class, right?
Correct.
Okay, thanks, Ramon. So I think finally, why don't we just move on to the house view then?
Yeah, sure. Let's go to the next and final slide. So I think in terms of house view, let's start with equities. Okay, so we are underweight on developed markets, particularly in the US market. But then again, this doesn't mean that we are going to sell everything, or you should sell everything out of your portfolio. It simply means that we are reducing our allocations. In contrast, as I've mentioned briefly earlier as well, we are overweight on emerging markets. We are neutral on both China and Malaysia. Okay, and moving to fixed income, we have an underweight view on government bonds. However, we are overweight on investment grade credit and emerging market hard currency debt. And finally, in alternatives, our view on gold is that we are overweight. So now let's take a look in terms of what these views actually mean for your investment strategy. If I could summarize everything into a key takeaway here, okay, is that the Federal Reserve is anticipated to make 5 more US rate cuts by end of 2026. We view this as insurance cuts and not recessionary cuts. And this basically suggests that the Fed is being proactive in sustaining growth and not reacting to a crisis. And if you were to recall as well, historical evidence, okay, shows that a potential rally in equities is possible even when prices are near all-time highs. So our focus in terms of style, okay, would be your large cap growth stocks, and we advocate and we advise a patient approach with small cap stocks for now. And at specific sectors, we have seen that technology and communication services have done historically well. Okay, so in terms of fixed income, as what Jason has summarized as well, is that the key assets to consider would be your intermediate duration treasuries, your investment grade credit, and your securitized assets. And we are taking a neutral stance on hybrid bonds. And finally, I think above all, the psychology and emotional aspect of investing shouldn't be overlooked as well. And if should there be a market gyration, I think that investors should use market volatility as an opportunity to rebalance their portfolios and to adopt the dollar cost averaging approach, which would work very well over the long term.
Okay, all right. Thanks, Ramon. I think that's a very that summarizes pretty much most of what we have for today. But I think maybe I do see one question here coming a little bit closer to home. I see that we are neutral here in Malaysia, but is there hope for Malaysia in 2026?
Well, as a Malaysian, I would definitely say there is hope. But of course, I think we talk specifically in context of the Malaysian stock markets. I think the stock markets in Malaysia have not gone anywhere in the last 10 years, but no doubt it has been showing some signs of life, especially for last year. But then again, I think the KLCI has not done really well for this year. And this is one reason is that because for foreign investors, they were taking their money out and they were putting in other areas like China, like India, South Korea, and whatnot. But still, I think with the change in tone in terms of what the Fed share has stated about a couple of weeks back, and in terms of where we see interest rates are going, I do think that the falling rates would make US yields not as attractive as before. and we could see a return of foreign inflows into the Malaysian stock markets and the bond markets. And I think in the last week itself, we saw about 230 million ringgit worth of inflows that is coming back. And from a technical standpoint, crucially, the KLCI has reached a very important 1600 level on that index. And we're looking that if this move could be sustained in the next few days, I think that 1650 is definitely within reach. So in terms of sectors, we have seen the local tech sector is coming back in a pretty good way, and in fact the consumer sector in Malaysia has been coming back as well, and we view this as being in line in terms of the domestic macroeconomic strength that we are seeing in the Malaysian economy. So yeah, in other words, we are slightly bullish on Malaysia.
Okay, all right, fantastic. There's hope for all of us here. Okay, thanks, Ramon. And again, once again, to our valued clients, thank you very much for joining us here this evening. As I mentioned earlier, please do reach out to your relationship managers if there is any part that you think that we did not manage to cover. And definitely we will be seeing you in the near future as we look to have more and more of these web-based sessions. So once again, from all of us here at Regional Wealth Management and Hong Leong Bank, have a very good evening. Thank you very much for joining us. Stay safe and good luck with all your investments out there. Thank you very much.
Thanks so much, everyone.
Thank you.
Great day.